Hello guys, good morning, good afternoon, good evening, depending on where you are. My name is CPA McCann, lecturer for financial management and financial reporting and analysis. In addition to that, I also teach taxation for Kenya. So therefore, I welcome you to my lessons. I welcome you to my YouTube lessons. I welcome you to every kind of video that I've actually shared in my YouTube. So when you want to search my name or get my videos, kindly reach us on 0735 346 777. At the same time, you can also find each and every video in our YouTube. That is CPA McCann, SIPS College, CIPS, SIPS College. Welcome and enjoy the topic today on introduction of capital structure. And before I do that, I would like to make some advertisement or some notification or advertisement to you. I have written a book called Fundamentals of Finance together with the financial management. So this is the topic, this is the subject that these are actually that I've written, and I request you to look for this particular textbook in the National Library of Kenya. If you go there, you'll find this particular textbook. At the same time, I've also sold some to University of Strathmore. I've also sold some to some of the colleges where they are being used to teach or coach CPS students. These are very summarized book, and it is actually containing each and every element of CASNEP. So therefore, I welcome you to go and read this book. If you are preparing for financial management, this is the best book. At the same time, it's written by CPA McCann, which is the person speaking before you is the author of this particular book. It's a very good book for financial management. Thank you so much. Yes, welcome to this topic. First and foremost, we want to end. First of all, let me highlight the topic. Let me highlight first of all the concept about this capital structure. First, by the end of the lesson, students must be in a position to explain the meaning of the word capital structure. That is my objective. That by the end of this lesson, you should be in a position to explain the meaning of the word capital structure. Number two, you are also in a position to explain the factors affecting capital structure. That is what I have to attain today. The third objective is to ensure that we are able to know what is cost of capital. Then from there, I will be able to know to give now the components of cost of capital. And then finally, I will be closing today with a subtopic called overall cost of capital. Overall cost of capital. Under this overall cost of capital, I will be discussing about weighted average cost of capital. Then I will close with what we call weighted marginal cost of capital. So in most cases, I will be referring this one as WMCC, and this one WMCC, and this one is weighted average cost of capital. So WACC and MCC. So by the end of this lesson, you will be able to know or to define the meaning of the word capital structure. 2, you'll be able to know the factors affecting the capital structure. 3, the cost of capital structure. 4, the components of cost of capital structure. Then the last part is overall cost of capital structure. First, let me start with the capital structure. When you talk about a capital structure, as the word suggests, we have capital here, which is something to do with the funds and finances. And then we have the structure here, which is like a building. So therefore, we can now say automatically that a capital structure is purely about a structure where you are analyzing the capital structure of the organization in relation to in relation to the composition or elements of that particular capital structure. First is to understand the structure. So, for example, this particular building is made up of the floor, is made up of the wall, and is made up of the roof. So, these all make up a house or a building. Therefore, any capital structure, any capital in an organization is either made of a debt or a equity. So therefore, debt and equity combined together is what we call a capital structure. So therefore, we can say capital structure here is refers to amount of debt and equity. Amount of debt and equity of an entity. Amount of debt and equity of an entity. So that amount of debt in an entity and that amount of equity in an entity is what we call capital what? Structure. This capital structure also can be defined by saying it is a mix. It is a mix of debt and equity. So any mix of debt and equity is what we call a capital structure. Now on this note, we can also say yes, this capital structure is very important because it brings what we call balance. Balance of finances. Balance of finances or capital. Balance of finances in the entity. Balance of finances in the entity is what we call the capital what? Structure. The question here is, how much is the debt in the capital structure and how much is the equity in the capital structure? Which one should be more than the other, or the equity and capital should be equal? That is a question that we are going to determine today. For that matter, we are going to analyze the cost of debt and the cost of equity. In most cases, if you see that the cost of debt is cheaper than the cost of equity, then you have to make sure that the capital structure containing debt is higher than the equity capital part of it. If you see that the capital equity is cheaper than the debt, then you have to ensure that the equity is higher than the debt. So the question here is, what is the meaning of the word equity and debt? Now, for that matter, before I go to that, let me go to factors. Factors affecting capital structure. Capital structure. Now, when you are talking about factors affecting capital structure, we are saying, what are these things that you consider before you say, I want this amount of money to be in the form of a debt and this amount of money to be in the form of equity? So what do you actually consider for you to know, for you to analyze or come up with the structure in which it is viable and it is practical to the entity? Number one, you have to consider cash flow. Cash flow of the organization. When you talk about a cash flow, we are talking about cash inflow and cash outflow. In this case, we are analyzing the cash that is coming in to meet all the liabilities in the organization. Now, in this case, we are now saying, yes, is your cash able to meet all the expenses in the organization? If the cash you are getting is able to meet the expenses in the organization, then we say that that particular entity is sober enough and it is able to add more and more capital into the organization. For that matter, the organization is able now to go for the debt because we have some money left behind that can be used to repay the loan. The second factor that you need to consider is what we call investment. Rate of return. Investment in, let me say, return on investment. Yes, return on investment. When you talk about return on investment, we are talking about the benefits that accrue to the owners or the providers of the finances. It can either be the institution, that is financial institution, or it can also be the shareholders of the entity. That means that if the return here, we are talking about the return here, return to the shareholders or debt holders. So if the return to the whole return to the shareholders is higher than the debt than the returns to than actually the cost of capital itself, then the best option is to bring in more shareholders. So when we talk about return on investment, we are talking about comparing the income against the expenses. So if returns are more than the cost of capital itself, then we can now say that it is good to have a capital structure that is made up of shareholders or a debt return. The third one is what we call control. In this case, we are talking about the power to manage capital. In this case, if the power to manage equity, to manage capital is within you, then it means you can easily make decisions to acquire more or to get more in terms of inviting more public to come and register or be part of the organization. Or it can also mean that if you want now to get loans, you can easily make decisions. So if you have the power over that particular entity, then decision making will be very easy. The third element is what we call flotation cost. Now, when we talk about flotation cost, we are just talking about additional costs. Additional costs. So in most cases, if we are actually acquiring a loan, there will be additional costs other than the interest. For example, we have the processing fee. We have also the advertisement if it is about the shares. We have the cost of advertisement. We have also the legal fee. So you consider also these factors, these additional cost when you are determining the capital structure. The fifth one is the tax rate. Tax rate. In Kenya, the common tax rate in Kenya is 30% on the profit before tax, to be 30%. So if this rate is higher, maybe to 40%, correct? It is better for you now to go for a loan because the tax rate is high. Let me explain why. When you say when a tax rate is high, is favorable for the debt, means that this amount here will actually attract an interest which is tax deductible, which means can be deducted or treated as what? Expense. This expense actually reduces the amount of profit. In this case, I'm going to discuss about it in detail also. Just let me leave it there. That when the tax rate is high, you can request or you can comment for application or acquisition of a loan other than equity capital. This is how you are supposed to analyze. So we are saying there are 5 main. 1 is cash flow, 2 is return on investment, 3 is control, 4 is flotation cost, then tax rate. So tax rate, when the tax rate is high, we are saying that the tax rate actually affects the interest of the organization. So the interest of organization is tax what? Deductible, or it can be treated as an expense. Correct. Now, before I finish, I can add another one, which is now the interest. We can say interest number 6. Let me add this interest cover. Interest cover rate. Now, when you talk about interest cover rate here, we are talking about the number of times earnings before interest and tax is able to cover what? The interest, the fixed interest. The number of times the earnings before interest and tax is able to cover the fixed interest. In this case now we can say it is earnings before interest and tax divided by the fixed interest. Fixed what? Interest. Earnings before interest or that. So in this case, If the number of times is higher, then the organization is at the right position and the liquidity of the organization is okay. So the organization is okay in terms of finances. Even if it applies for the loan, it means that it is able to repay that particular loan. But if you find that this particular ratio here is less, in the case of maybe, for example, in year 1, we have 2, year 2, we have 3, and year 4, we have 4. When you calculate this ratio and it's keeping on increasing like this, it means that the earnings before interest is able to pay the fixed interest every period because it is increasing. But if you find a scenario where it is now decreasing like this, as a finance manager, do not advise the organization to apply for the loan. Why? Because the number of times in which that particular earnings before interest and tax able to cover the loan is keeping on what? Decreasing, which means that there will be a lot of uncertainties in the future. So we go to what we call components. And before I go to the components, I want to discuss about the equity and debt first. Equity and debt first. Yes, debt and equity. I want to introduce this one first before we go to cost of capital. When you talk about a debt, it means that this is the capital or funds obtained from the financial institution. So when you talk about a debt, we are talking about funds from financial what? Financial institution. Correct? So which means it can either be a bank, a SACCO, or any other entity that is providing funds in the form of a loan. And these examples of this debt can be debentures. Okay? It can also be bonds. And it can also be loan, the normal loan. Correct? Now, for that matter, we have to understand at what time do we say we need to increase the debt. This you need to get clear from me now here. That when you talk about a debt, it is risky to the entity. Why? Because it attracts what they call financial risk. And when we talk about financial risk, we are talking about repayment of the debt in the form of what? Interest. Repayment of that loan in the form of interest. In this case, it means that if the organization did not make enough profits for that particular year due to calamities or due to challenges that affected the business in that particular period, it means that the profits are not there, or maybe the organization has made what? A loss. Therefore, it means that the organization will face financial risk because this debt here that you have applied is fixed and no negotiation. Once you have signed that contract, it is final. So even if you have made the losses, the provider of that particular loan would not want to hear about deferring this particular loan, but you are supposed to pay. Therefore, we are saying because of that fixed terms in the loan, you are not able to skip it. Therefore, it is risky compared to equity. Another thing we can say is, we can also say that the debt is cheaper than equity. Here, when you talk about equity, you are just talking about the shareholders' contribution to the entity. It can either be in the form of ordinary shares, preference shares, or retained earnings, which is now in the organization but is owned by different people. Here we are saying debt is cheaper than equity. Why? This is the reason. This debt here will automatically introduce or attract what we call interest. So interest is tax deductible. That is to say, it is an expense. The tax authority agrees with you when you treat interest on that particular loan as an expense in the books of accounts. So therefore, it is allowed. That is why we are saying it is cheaper than equity. Now, when you talk about equity here, it will attract what we call dividends. Dividends here, we are talking about now the ordinary shares dividends and the preference shares dividends. These dividends here are not deducted or are not treated as expense to the organization. That is to say that you cannot subtract or deduct expenses from the revenue for you to get the net profit for the for you now to apply the tax rate. But for the interest, you have to subtract interest, then the amount remaining, that is where you apply your tax rate. But for this one, you cannot subtract dividends, then you come and apply now the tax rate. No, you apply the tax rate first, pay the tax, then whatever that is remaining, you distribute now as dividends to the shareholders. So therefore, it means that this equity is expensive because we cannot deduct it as expense. So you can say it is not an expense. That is why it is expensive. So a question will be said that explain this sentence. Debt is cheaper than equity. Correct. Now, when you talk about equity here, we are just talking about funds contributed from shareholders, funds belonging to the shareholders, and retained earnings. Shareholders and retained earnings. So these two will make what we call the capital what? Structure. Now we go to another topic called cost of capital. Yes, cost of capital, an expense that an organization is experiencing because of the capital. So therefore, when you talk about cost of capital, we are just talking about amount of money payable to capital providers. That amount of money you are paying to the capital providers, what do you call it? Cost of capital. Then the question here is, these capital providers will give us now two aspects. Aspect number one is what we call cost of funds. Or let me just say cost of debt. Let me be specific. Then we have also what we call minimum return. Now, when you talk about cost of capital, these two terms must come in your mind. Cost of fund. Let me go by the word fund. That is the correct one. When you talk about a cost of one, here cost of fund, you are actually talking about actual debt payment. So this one you are paying specifically to the financial institution where the loan originated from. But when you talk about a minimum return, here we are talking about, in this case now, we are talking about dividends to the shareholders. So the shareholders bring in their money into the organization because they expect what they call a minimum return. So in this case, these people here that get actually minimum return, that's why we are saying in this case it is less risky. So equity is less risky because you can easily negotiate with the shareholders. Then you can tell them that this year you have not performed well. So the performance of the performance of the income statement is not attractive at all. So therefore, we will not pay you the dividends at this particular rate, but will reduce, or will not pay you this year the dividends because of the performance of the entity. So from there, they will listen to you, and because of that, it means that the risk in relation to the payment of debts is what? Fair, not like the one in the debts. That is how it should be done. Now, once you have known that cost of capital refers to the amount of money payable to the capital providers, then therefore we can say the cost of capital is also the same as what? When you talk about cost of funds or cost of capital, is also the same as minimum rate of return. So we can now say cost of capital equals to minimum rate of return. Minimum rate of return. So this cost of capital here is purely, when you are talking about this one, you are talking about the debts which is now giving you what? Interests. And we talk about this one, talk about the dividends, which is payable to ordinary shareholders, and is also payable to preference shareholders. So when you say cost of capital and somebody saying minimum rate of return, they are talking about the same thing, because both actually refers to the cost of getting that particular fund, either in the form of a loan or in the form of capital. So for that case, you are just meaning the same. Most of the questions that we are going to discuss, you will find that they will be talking about cost of capital. Some will say referring to minimum rate of return. So let's go to, now after knowing what is cost of capital, let's go to components of cost of capital. Components of cost of capital. Components of cost of capital. Now, what are the examples of cost of capital? Example number 1, equity. Okay? Example number 2, debt. So there are two types of this one. There are two types of cost of capital. Now, when we talk about equity, we are going to look at it in two ways. Way number 1 is what we call ordinary shares. Okay? Ordinary shares. Now, when we talk about ordinary shares, these ordinary shares, it means that this is the capital contributed by shareholders into the organization. For that matter, the cost here is dividends. Okay? The cost under ordinary share is dividends. So this cost of capital under ordinary share is what you want now to know. Remember, I covered the topic called business valuation. That is now, I think 1 month ago. It is in our YouTube. So business valuation. You will see that there I was covering about valuation of ordinary shares. The formulas that I used at that time and the formula I'm using today, they are similar. Only that I'm going to interchange the cost of capital together with the market value. For that case, business valuation, you are discussing about market value, the value. Here we are talking about the cost. So they are the same. So you might find that whatever I'm discussing is similar. So you might think I'm repeating. No, this is about cost of capital. The other one was about business valuation. Now, in this case, these dividends here can either be paid where, Roman 1, where there is zero dividend growth rate. In this case, we are paying dividends, but the dividends are not growing every year. Correct? So we have just made the dividend rate to be constant and fixed. It cannot increase or decrease for several years. So therefore, we can say cost of equity, in this case, we are going to say KE. In this case, I'm saying now cost of equity now is given by DPS or a D0, or you can say DPS over market value. And this market value in most cases is affected by flotation. Now, let me explain something before I move on. When you talk about market value and flotation, assuming, for example, you have gone to the market and you have bought sack of cabbages. For example, sack of cabbages at 500 shillings. This sack of cabbages you have bought from the market need to reach your place where you do your business. So you need a transportation cost. So this amount here is a market price. The transportation cost will reduce this, assuming now you have been charged 100 shillings from where you do your business. So the correct market value for that cabbage should be 400. So therefore, the market value is mainly affected by flotation. And I've said flotation here is the additional cost one incurs to secure that particular loan. So therefore, in this case, we are saying market value is affected by flotation. So flotation will reduce the market value. That is number one. Number two, on the same equity, we can discuss about constant. We discussed the same also in business valuation. Constant dividend growth rate. Constant dividend growth rate. This is where the dividend payment is growing at a particular constant growth rate up to a certain period of time. So in this case, it is not like this, where you are paying just once, but in this case, you are paying, but it is growing every year. Therefore, it means in this case, we can now say cost of equity is given by D0. This is the current dividend. The current dividend that we have just paid. Then if you want now to make this current dividend to go to year 1, year 2, in year 3, we will have a growth, which say now 1 plus G. So if you say now D into bracket, this is the growth. It means the dividend paid in the current year can, by the end of the first year, it would have grown by 1. Okay, so instead of me now indicating that one, I can just leave like that, because it means it is growing after 1 year. Then I will divide by market value minus any flotation. Then this answer I will get here, I will add my growth. So therefore, I can say authoritatively that D0 or D1 is given by D0 into brackets 1 plus G. Then if I want to get for dividend after year 2, it will be D0 into brackets 1 plus G power 2. And if I want to go to predict the dividends after year 3, it will be D0 into 1 plus G power 3. So you can see the dividends are growing from year 1. Year 1 is D0 from the current dividend. So D0 here, this stands for current dividends. This one stands for dividend after year 1. So therefore, in our formula, we need dividends after year 1. Here we don't have any growth. Therefore, it means it is an amount of money that is paid in the form of dividend will remain constant. But in this case, it will appear like that. The second element here, the second under equity, under ordinary share, let me label this one as A. B is what they call retained earnings. Retained earnings. So under equity, we have retained ordinary shares and retained earnings. In this case, you can represent it as KR, cost of retained earnings. This cost of retained earnings might also be increasing every year, correct? But now, because this is your money, this is what you have already, so there will be no any additional cost. It's like the money you have in your pocket. The money you have in your pocket does not attract any cost. But for this one, but for the ordinary shares, because you need now to do advertisement, you need now to do what we call flotation, you need to advertise and maybe look for the lawyer to draft the prospectus. From there, you will be incurring some additional cost. But for the retained earnings, you don't have any additional cost. Therefore, in the simple terms, I'm saying the formula will remain the same, but there will be no flotation. But growth is also growing as usual. So we can now say cost of retained earnings is given by D0 into brackets. Okay, you can say dividends or earnings. Okay, let me just say into brackets earnings. Into brackets 1 plus G, it is growing, divide by P0, U plus 1. So I'm removing flotation because this is already what we have. So it cannot affect that particular flotation. So that is first component of equity. The second component of equity is what we call debt. Debt, now here I'm going to look at it in 3 forms. Form number 1 is loan, normal loan. Let me just say A, debt loan. How do I get the cost of loan? The cost of loan is always given by profit after tax rate. Now, the cost of loan is exactly the profit after tax rate. And this profit after tax rate is gotten by saying pre-tax, pre-profit, pre-tax rate into brackets 1 minus T. So the pre-tax profit, sorry, let me say it is pre-tax profit. pre-tax profit. Pre-tax profit rate into brackets 1 minus t. So for me to get the profit after tax rate, I have to take pre-tax, which means before tax rate, which is now 1 minus t. How do I calculate this? How do I arrive at this? I have to take 1 minus t. T is the tax. So immediately subtract tax. You get now the profit after tax. So therefore, loans are given by saying pre-tax rate into brackets 1 minus t. Then another element is what you call debentures. Or I can say bonds. Bonds now are in two categories. Category number 1 is redeemable. Redeemable. When you talk about redeemable, it means it can be purchased at the end of the expiry period. Maybe the loan is for 20 years. Immediately the expiry of 20 years, the loan need to be bought back to the provider. So we say redeemable loan. For that case, this redeemable bond is called yield to maturity. Yield to maturity. So yield to maturity is now abbreviated as this one here. Yield to maturity is calculated as int, that is interest, into brackets 1 minus t. This is now pre-tax interest rate. When you subtract, we say now minus t is now profit after tax rate. This one here. Then you now say plus m minus v plus vd. Then 1 over n, everything over m plus v d over 2. So I want to explain the meaning of each and every word from that particular element, each and every word from each and every component there. Correct. Now, for that note, let me correct here. It is not minus plus, but it is minus. So I'm subtracting. It is minus. Now let's see. Yes. So I'm saying, yield to maturity is given by int 1 minus t plus into brackets m minus vd, then 1 over n, you divide by m plus vd 1 over 2. Now, this formula is very simple. This is interest, which means you will be given a loan with its interest. Then when you say 1 minus t, it means that you are subtracting tax. Then here, m stands for par value of the debt. This is the value of the debt in the books of accounts. Then VD stands for value of debt, which means this is the current value of the debt. This is the market value of the debt now. But in the books of accounts, we call it par value or nominal value. Sometimes we call it nominal value. This is nominal value. Now, value of the debt, in this case now, is given value. This is the market value, and this is the nominal value. So therefore, we have to compare the market value minus the nominal value, that is the par value, minus the market value here. You will be able to get the difference. If this one is more than this, it means that we have lost. But if this is more than this, means that we have gained. Therefore, once you have subtracted this one, you will multiply by 1 over n. N is the number of years or periods. Then we have 2 here. 2 is this a half. So the answer you get here, you multiply by a half. Now, that is example 1. We have irredeemable. Irredeemable. Irredeemable here, we also call it flat yield. Flat yield. Flat yield in most cases, this means that this particular loan or debt will remain into the organization as long as there is no suggestion to wind up that particular entity. The entity will continue for foreseeable future, meaning that there will be no end of that particular, so you will not be able to buy the loan there. So therefore we can now say, okay, for that case, we can say cost of that debt is given by int into brackets 1 minus t over the value of the debt. Value of the debt. Value of the debt means the market value. So when you subtract now, you will be able to get that. Another form, number 3, the first one was equity, second one is debt, and then the last one is preference shares. Preference shares, P, KP. Preference shares is also part of the capital that has been contributed into the entity. For that case, now we can say, okay, cost of preference is given by DPS over market value minus any flotation. Now, do we have growth in the preference shares? The answer is no. Why? This is a fixed dividend that is paid to the shareholders. But ordinary shares, it is not fixed, it is negotiable. This year we can say we can increase, next year we can say no, we are not increasing. But for the preference shareholders, the dividends paid to the shareholders is fixed. This is how it is expressed in the question. They might say 10% preference shares of shillings 20. It means the dividends is at the rate of 10% per share. So therefore, for me to get now the DPS, it will be 10% of 20, which is 2. So therefore, the dividends here, the DPS here will be 2. If they say 8% preference shares of 10, correct? So it means the dividend rate will be 8% of 10, which will give you what? 0.8 shillings. This what I've done here is what they call components of cost of capital. Let's name them. One, equity, which is made up of 2 ordinary shares and ordinary share capital and what? Retained earnings. 2, we have also said debt. Debt is made up of 2 or 3. 2, yes. The first one is loan. The second one is debentures or a bond. Bond is now made up of either you will buy it redeemable or redeemable. Irredeemable means you will not buy it back. But redeemable means that it will expire. By the end of the period, you will bring it back. Another one is what you call preference share capital. So therefore, class, welcome to the computation now. We now go to computation class on examples. So we start with the example 1. Let's see example 1. Now we go to example 1. Example 1. So let's see example 1. I hope you are there now. Example 1. Example 1. Yes, let's now do computation on this particular area, example 1. So if you don't have notes, kindly reach us also on 0735 346 777. You will find us also on our WhatsApp. WhatsApp us and we'll be able to respond to your case. If you need notes, we shall share. So let's go to example 1. 1 says, assume that the market price of the Jubilee company stock is 40 shillings. The dividend to be paid at the end of the coming year is 4 shillings per share and is expected to grow at a constant annual rate of 6%. Determine the cost of common stock. I want you to underline the word common stock. Common stock is also referring to ordinary shares or equity. So when you see the word common stock, we are just referring to ordinary share capital. So where there is common stock, we put that element. So they're saying determine the cost of common stock. Common stock is ordinary share. So in this case, they are saying cost of equity is given to D0 into brackets 1 plus G over P0 minus F plus G. D0 is the current dividend. If I bring in this variable here, it automatically grows this current dividends to dividend after year 1. So therefore, this one here denotes dividends after year 1. Therefore, in a given question, you should be very careful. Know whether the dividends given is the current dividend or a dividend given is after 1 year. If it is after 1 year, don't grow it here. You just directly substitute here. But if the question is saying it is the current previous year, which means you have paid this year, so it has been paid already. That is now that if it has been paid already, it means that you need to grow to get the dividends after 1 year. But if the question says that is to be paid after 1 year, which means that is D1. So which means don't bring this formula here. But if they say it has been paid, you come and pick it from here. So let's see from the question. Assume that the market price of the Jubilee company stock is 40. Market price. So we say now P0, which is this now, is 40 shillings. Comma, is 40. The dividend to be paid. The dividend to be paid. Has it been paid? No. At the end of the coming year is 4 shillings. So it means that is the dividend after year 1. So we will not say D0, but we'll say D1 is equals to 4. Not D0. There are some questions that I will be indicating here D0. Then they are also saying is expected to grow at the annual growth rate of 6%. Now growth rate is 6%, 0.06. So I have all the information now to fit in here. Now substitute. They say cost of equity is, instead of this one, I will pick this. So it means D0, D1 over P0 minus F plus G, which is D4 over 40 minus 0, which is not there, plus 0.06. This will give you 4 over 40 plus 0.06. So if you work out using your calculator very well, your answer you will get is 16%. Example 2. Plato companies common stock. Common stock here is what? Cost of equity. Stock is selling at 50 shillings. That is P0. Last year's dividend was 4.8. Last year's, which means current dividend, D0, not D1, was 4.8. Compute the cost of retained earnings if both earnings and dividends are expected to grow at 0 percentage and 9%. So to grow at 0%, another one is at 9%. So this is a very simple question. So they are saying A, growth is 0%. B, growth is 9%. Now we extract information. Market price P0 is 50. Then last year, which means D0 now, is equals to 4.8, which means it will grow now. We will use this first part of the formula, not the last part of the formula. Then compute the retained earnings, the growth of that. So you are finished. So for A now, I say cost of equity now. This one is retained earnings, sorry. This is purely about returns. Cost of returns, retained earnings is now given by D0 into brackets 1 plus G over P plus G. I'm not saying minus F because there is no flotation for that matter. So in this case, I have, you substitute what you have here. So I have, there is nothing here, so it is 0. So I will now pick D0. You have been told the dividend growth rate is how much? 4.8. You divide by 50, then you add 0, you add G. This is G. You add 0.0. 0. Okay, sorry. 0, like that. So there will be nothing there. So what is your answer? So because here will be 0, this one will be, so there will be no growth. So the answer you'll get there is 9.6. 9.6%. B, there is growth rate. So KR is equals to D into brackets 1 plus G divided by P0 plus G. So bring here, it is 4.8 growing at what rate? Like that. Then you divide by 50. Then you add 0.09. So if you work this one using your calculator properly, then you add this, your answer you get is 19.5%. I want you to take note of D0 and D1. At what point do we say D0? Go back to the notes or go back to the video about business valuation. You will see how I've analyzed this correctly. But in this case, I'm just making the summary by saying D0 means the current dividend. D1 means the dividends after year 1. If you have been given already dividends after year 1, then you don't need to say 1 plus G. You just put there your D1 over P minus, then you add that. Example 3. Example 3 is also based on the same. So example 3 says, suppose that Jubilee Company has preferred tax. So the preferred stock that pays 13 shillings dividend per share and sells for 100 shillings per share in the market. Sells. The flotation cost is 3 shillings, 3% or 3 shillings share per share. Determine the cost of preference shares. So they're saying preferred stock. Preferred stock is preference shares and common stock is ordinary shares. So in this case now, we can say cost of preference share is given by DPS or over P0 minus F. So there is no growth here. So let's see now what is happening. They are saying, let's extract information. Suppose that Jubilee Company has preferred stock that pays 13 shillings dividends, pays, which means D is equals to 13 shillings. Then, and sells for 100, sales is market price, P0. So P0 is equals to 100 shillings. Then they are also saying the flotation cost is 3%. 3%, which means 3% of this will give you what? 3% of the market value is, flotation is always on the market value. So 3% of this is 3 shillings. So in this case, you can now say F is equals to 3 shillings. Then determine the cost of preference shares. So you can say cost of preference now D, which is 13 over market value 100 minus 3. This gives you what? 13 divided by 97. If you work out that carefully, your answer you will get is 13.4%. You can see how flotation is affecting the market value. Now we go to example 4. Assume that the Jubilee Company issues 1,000 shillings, 8% interest, 20-year bond whose net proceeds are 940 with the tax rate of 30%. Determine the cost of debt. Debt now, they are saying there are two. You ask yourself, is it irredeemable or redeemable? Redeemable means you will purchase it at the end of the year. And that one can only be determined by the periods given. And irredeemable means you cannot purchase it at the end of the period. So there is no end of the period. In simple terms, to identify the two types of debts, you just look at the periods. If periods given, then it means automatically that is redeemable. If there is no period given, it is irredeemable. In this case, you have been told 20 years. Therefore, it is redeemable. For that case now, we say number 4, this is redeemable. So we say now yield to maturity, which is now redeemable share, is given by int into brackets 1 minus t plus into brackets m minus value of debt 1 over n. Then you divide everything by m plus value of the debt, then 1 over 2. Once you have written your formula down like that, then you come now and underline the question one by one. They are saying, assume that Jubilee Company issues, which means a loan of 1,000 shillings debenture. So you say that is the nominal value. That is the value of the debt in the books of accounts. M is equals to 1,000. Under this 1,000, there is an interest of 8% int, which is 8% of 1,000, which will give you 80 shillings. Correct? Then they are also saying whose net proceeds, which means market value of that loan of 1,000 is 940 net proceeds, which means that in the books of accounts you have indicated 1,000, but when you take this particular loan out there, it will only go at 940. That is what they call value of the debt. So value of the debt now is 940. So, and then T there we have been told is 30%. T is 30%, which is 0.3. Then you have everything. Substitute in your formula now. So you say yield to maturity is given by 80 into brackets 1 minus 0.3 plus into brackets 1,000 minus 940, then 1 over n. You divide everything by 1,000 plus 940, then you multiply by half. Then you work out slowly one by one, the numerator first, then also the denominator again. Then here you will get now 80 times 0.7, which is 1 plus, this one is subtract, you get what? 60, then 1 over 20, right? Sorry, here is 20. Then you divide everything by 1,940, you get what? A half. If you work this one means this times that, this times that. So if you work out carefully, your answer you get is 9%. That is example 4. So how do you find? How do you see this topic? So after this, you are supposed to practice the formulas that I've just given out, then try to follow the examples that I've given. So let me go to a small part now. Overall cost of capital. Yes, overall cost of capital. First and foremost, we have discussed about components of cost of capital. We are in a position to calculate the cost of ordinary equity shares, retained earnings. We are also able to calculate the cost of preference shares, and we are also able to calculate the cost of debt. These are 4 components of cost of capital. These 4 components of cost of capital, if you are now to know how much is the cost of capital for all of these, so we get what they call average. That average cost of capital, from all the sources that we have mentioned, is what they call overall cost of capital. So therefore we can say overall cost of capital means average cost of all sources of capital. Very simple. Overall means average cost of all sources of capital. That is equity, retained earnings, debt, and preference. All of them at the same time. So therefore, we want to get one figure to report to our shareholders to summarize all the sources of capital. Now, for us to do that, we need to calculate what's called overall cost of capital. So overall cost of capital has its own stages. Stage number 1 is compute cost of capital for each source. Which source? If it is cost of equity, calculate equity, calculate the cost of retained earnings, calculate cost of preference shares, calculate cost of debt. That's what they are saying. The normal way, the one we have just completed, that is example 1 to 4. Calculate example 1 to 4 here. Number 2, once you have done that, calculate what they call proportions, or yes, proportions. Proportions. This one is, you can also call them what? Weights. Weights is now how much is equity out of the total, which means equity over the total capital. You get that proportion. That is the weight. How much is that weight? Now the question here is, For us to get that proportion, that is how much is the equity in the total, how much is the retained earnings in the total, how much is the preference shares in the total, and how much is the debt in the total. For us to do that, we have to calculate what we call proportions or weights. The challenge that is there is which value are we using? In this case, there are two values we can use. Value number one is book value. You can use book value of the capital to calculate the weights or proportions. When you talk about book value, we are just talking about the carrying amount or the value of this capital in the financial statements. How much is it shown in the financial statement? It's what we call book value. Or we can decide to say, let's use the market value. Now, when you talk about the market value, we are just talking about value in the market. This is now the price in the market. And in most cases, we normally use the market value instead of book value, because book value here means history. We are using the historical values. So the historical values in most cases are not used in decision making. But the one you can use to make the decision is the market value. How much is it in the market? So it depends with the question. If the question says calculate the overall cost of capital use book value method, which means go directly to the historical value. But if the question does not direct you what method to use, you just go directly use the correct method, which is the market value. Therefore, it means in the case, for example, we have 10 shillings shown, 10 shillings ordinary shares. What is this 10 shillings ordinary shares now in the market? Maybe this ordinary share in the market is going at 100 shillings. So 100 shillings is the market value, while 10 shillings is the book value. So it will depend. Now, for the sake of learning, we will use the two, book value and market value. But if the question does not tell you which one to use for you to get the weights, you just need to use the market value. And if you don't want to use the market value, use the book value, ensure that you bring the note. Because it is known that for us to make the decision, we have to use the market value. Then number 3, the third stage is now calculate the weights. Calculate the weighted cost. So determine now the weighted cost, meaning that the first one you have already the cost of capital, then we have the weight here. Therefore, you now say that cost may be 10% times the weight. Maybe you have found the weight to be 2. So what is the answer here? 2. So then from there, the fourth one is sum or add. Add all the weighted cost. So the first step, calculate the calculate the cost of each source of capital. 2, calculate the proportions, either using the book value or market value. 3, calculate the weighted cost. Number 4, add all the weighted cost. Add all the weighted cost. So let's see example, class. Example number 5. And actually, before we move on, let me just say now, for me to get now this one, I can now say overall cost, KO, average cost will now be, I will take the cost of equity, and it will depend. If I'm using market value or book value, I say now equity value in the book value divided by the total value plus the cost of preference, then preference, not market but book value divided by book value plus maybe I have cost of retained earnings, and then retained earnings value over book value plus cost of debt. 1 minus D. Remember, I'm doing like this because of what? I've already discussed this. So 1 minus t, 1 minus t, then d over b. Where I can now say B stands for book value, book value. What is the book value of the equity over the total book value? Then total book value, I mean now book value of equity plus book value of preference plus book value of retained earnings plus book value of debt. You get what? Total book value. Now, because I've calculated this, so from working number 1, then proportion is now, this is my proportion here. This proportion here is this. I'm taking equity at book value divided by the total. Then proportion value for preference is this one. Book value for preference divided by the total value, then you get the answer. And then it can, if you are using the market value, it will be cost of equity times equity at market value divided by the market value plus preference, cost of preference, preference over market value plus cost of retained earnings, then retained earnings of the market over the market value, plus cost of debt, 1 minus t, then d market, this is b over market value, like that. So if you are using the market value, be very careful. So by using this method here, this one is what you call what? Overall cost of capital, which we are going to discuss about weighted average cost of capital. And before we go to that, let's now do example here. Example 5. Example 5. Example 5. So example 5 says capital structure of Arunada Limited along with the respective specific cost of capital is given below. Cost of capital already it has been calculated, so your work is very simple. You are required to compute the weighted average cost of capital, which is now, they are saying weighted average cost of capital. Weighted average cost of capital is also the same as overall cost of capital. Weighted average cost of capital is the same as average cost of capital. So you are required to compute the weighted average cost of capital using A, book value as weight, B, market value as weight. So let's see this information. So information is given here. They are saying source, we have equity shares, we have book value, we have market value, then we have after tax cost of capital. So we can see the source is here, book value, market value, after tax cost of capital. This is now where we have the cost of capital for each source. So we have equity there, which is here, book value is 800,000, market value is 1 million, then cost is 15. We have preference shares, 200,000, market value is 150,000, then rate is 12%. Debentures, we have 150,000, then we have 150,000 market value, then we have 8%. Then we have retained earnings, in this case is 50,000, Then we have also 50,000, but we have not been given after tax cost of capital. So after tax cost of capital for the retained earnings is not given. So you have been told you are supposed to calculate weighted average cost of capital using what? They are saying weighted average cost of capital using book value. So our work is very simple. Get the total value for book value here. Get the total. Get the total value for the market. If you add all, your answer you get for the book value is 1,200. Book value. 1,200, sorry. Then this one you will get 1,350,000. Okay? Now, look at retained earnings. It is not there. We have not been given the cost of capital. How do you calculate the cost of capital for retained earnings? So we have said the only difference between the cost calculation for the capital of retained earnings is that there is no flotation. But the formula that was used to calculate equity, this one here, is the same as formula used to calculate retained what? Earnings. The only difference is flotation cost. Therefore, it means this question mark here, this cost of equity is the same as cost of retained earnings. Why? The formula is the same. The only difference is flotation cost. From the question here, we have not been given anything to do with the flotation cost. So therefore, we can now say the cost of retained earnings is the same as 15%. Now let's calculate here now. The first point is calculate the cost of capital for each source. Already done for you. Number 2, calculate the weights for each source. Weights means now you take now equity divided by the total, preference divided by the total, debenture divided by the total, retained earnings divided by the total. You get what? You get now the proportions or weights. If you are working using the market, it will be this divided by this divided. So you get what you call proportion. Then our work is very simple. Now we say work is given by cost of equity using the market value, book value over the total book value plus cost of preference of market value, book value over book value plus cost of retained earnings, which is retained earnings, book value divided by book value plus the cost of debt 1 minus T, which means dB over D. Very simple work. Then you substitute cost of equity 15% times equity book value 800 plus cost of preference 12%, market value of preference 200,000. Let me use 800. Okay, I'm just using 800 because it is 1 million. So like that, plus retained earnings 50. So I say 50. No, sorry, this 15% times 50. Then the last one is 8% times 150. Then you divide everything by the total book value. This one here. Oh, sorry, here is B. Divide everything by 1,200 because I'm doing that. If you trace your calculator very well, your answer you get is 13.6. So the overall cost of capital using this composition structure is 13.6 if I use the book value. What if I use the market value? Correct? Now, the formula remains the same. Cost of work, so let's say work now, is equals to cost of equity multiplied by equity at the market value divided by the market total plus cost of preference preference market value over market plus cost of retained earnings market divided by the market plus cost of debt 1 minus t, debt at the market value over the market. Substitute cost of equity 15% times the market value 1000 plus cost of preference 12% times the market value 150 plus cost of retained earnings 15% times the market value 50,000, then plus cost of debt 8% times market value 150. You divide everything by market value 1,350,000. If you work out very carefully, your answer you will get at the end here is 13.8%. So this is what they call overall cost of capital, or a weighted average cost of capital. That is how you are supposed to arrive at this. So in simple terms, I'm saying, let me make conclusion before we proceed with the computation. So, in simple terms, I'm saying weighted average cost of capital is what? Is the average of all sources of capital. This average of all sources of capital. And it is also called average overall cost of capital. Now, so average of all sources of capital existed. Now, what if we want now to add additional fund or additional capital into the organization? That additional fund into the organization is what we call marginal cost. So we are adding what we have already. We have already the capital structure here, but we want to add the debt, or add the equity, or add the retained earnings. That additional capital is what they call marginal cost. Marginal. So for that case, we have what they call weighted marginal cost of capital. This one is abbreviated as WMCC, weighted marginal cost of capital. What is this now? This is the average cost. It is the same, but you say now is the average cost of additional capital in the organization. In the organizational capital structure. In the capital structure organization. So let me simplify in the additional capital in capital structure. So any additional cost because of the additional fund will attract additional cost. That additional cost is what we call weighted marginal cost of capital, NB. WMCC procedures are the same as weighted average cost of capital, which is procedure 1, compute cost of capital for each source. 2, compute weights. either using the book value or market value. 3, compute the weighted cost. Then the last one, number 4, add the weighted cost for all sources. That is how you are supposed to compute. Let's see example, then I will give more you to do later. So let me do an example here. So we have example 6, which is shown in our notes also. Example 6 is in our notes. So let's see. The question is very simple. It's saying the Gamma Product Corporation has the following capital structure, which it considers optimal. So this is the capital structure. So we have bond 7%. 7% par value, 7% par value, 300,000, 300,000, preferred stock, shillings 5, 240,000, common stock, which is 360,000, then retained earnings, 300,000. That is the question. So this is the capital structure that exists at the moment. So therefore, what is this? This is the capital structure that exists now. Let's see whether there will be any additional capital to this particular capital structure. Dividends on common stock. First of all, common stock is the same as equity, right? And this one is preference. Just understand that. Yes. The dividend on common stock are currently 3 shillings per share and are expected to grow at a constant rate of 6%. That is currently, which means D0. Then it's growing at the rate of 6%. Market value per share of common stock, which is equity, is 40 shillings. And preferred stock is selling at 50 shillings also. Flotation cost on new issue of common stock is 10%. So flotation cost, 10% on common stock. The interest on bonds is paid annually. The company's tax rate is 40%. Required, calculate A, cost of bond, B, cost of preferred stock, C, the cost of retained earnings, D, the cost of new common stock, C or E, weighted average cost of capital. So our work is simple. First, this is our capital structure, correct? So this capital structure is very important. So let's see. This is now the book value. When you see something like this, it is the book value. This one here. Now, you have been given 5 shillings here to inform you that 5 shillings per preference share. One preference share is equals to 5 shillings. What about 250,000? Okay, so let's see. Dividend on common stock are currently 3 shillings per share. That is what? D0 is equals to 3 shillings. And are expected to grow at the rate of 6%. G is equals to 6%. This is common stock, which is equity. So when I'm analyzing equity, I have this information given. Correct? Then market Market price per share of common stock is 40 shillings.
So P0 is equals to 40 shillings. So I have already enough information about equity.
Let's proceed. And preferred stock,
That is preference.
Preference, we have been told selling price,
that is P0 is equals to 50 shillings.
Market, then flotation cost on new flotation cost.
So we have now flotation cost on specifically equity is what?
10%.
10% of what?
Market
Value, which is this one, 40. Will give you what? 4 shillings. So I have enough information. Now I can remove this because it is about equity, and I put here flotation is equals to 10% of 40 will give you what? 4 shillings.
So I have enough information about equity. Let's go. So I have bond is not given, so I have this one. Preferred, I've calculated. Common stock, I have it here. Then bond. Let's see whether there is any information about the bond. The interest on bond is paid annually. The interest on bond here is paid annually. What else? Is paid annually. So there is nothing again given. The corporate tax is 30%.
So calculate A. A is saying cost of the bond. Cost of bond.
Look at the bond carefully. This bond here doesn't have the market value, P0. Correct? Therefore, this particular loan here is in the form of a loan. Because it doesn't have the market value. And it doesn't have also the period, whereby you can now classify it under debentures or bond. So therefore, this is a pure loan. Like that.
So if that is the case, the cost of the loan is given by pre-tax rate into brackets 1 minus T, which is now pre-tax rate, that one, 7% into 1 minus 0.4. This gives you what? This gives you 7% times 0.6 will give you 4.2.
4.2%.
B.
Cost of preference shares.
Cost of preferred stock. KP is equals to DPS over P0 minus flotation.
And let's see. DPS. Have you been given the DPS?
Yes. It is already here calculated.
5 shillings.
So you take now your 5 over the market price. How much is the market price? 50. Is there any flotation for
preference shares? No. Flotation cost that we have been given is for the equity common stock. So we don't have.
So when you subtract, we work out this one, you get what? 10%.
Next is cost of retained earnings.
C. Cost of retained earnings, which is the same as what? D0 into brackets 1 plus G over P0 minus plus G.
So do we have any information? Yes. D0, 3.
So 3 with the growth is 1.06. Divide by market value
of that particular cost of retained earnings, 40,
plus 0.06.
If you work out that carefully, you'll get 14%. Next, cost of new common stock. Cost of new common stock. Now, remember, cost of retained earnings does not affect what? It's not affected by flotation.
So D, cost of common stock, which is equity, which is KE is equals to D0 into brackets 1 plus G over market value minus flotation plus G. This is where the difference will come in here. So this gives you what? D0 is 3 into 1.06 divided by market value 40 minus flotation 4 plus 0.06. This will give you what? This will give you, this is 3 times 1.06 divided by 36 plus 0.06. This will give you 14.83%. Now, if you go to the last one, which is the weighted average cost of capital, D, weighted average cost of capital, which is given by cost of equity, equity over value, plus cost of preference, preference over value, plus cost of retained earnings over value, plus cost of the debt, into brackets 1 minus T D over V. So how many are they? So we have 1, 2, 3, and 4. 1, 2, 3. Sorry, 1, 2, 3, 4. So we substitute. Cost of equity is the last one that you have just calculated, 14.83 times the value. So in this case now, we can calculate our market value. Let me calculate the market value. So this is book values. Let me get the market value here. Now, the market value for the bond, we have not been given any, therefore it will remain the same, 300,000. But now, there will be a problem here for the preference share. One preference share is equals to 5 shillings. What about this one? To know the number of preference shares, then multiply by the market value of 50. So, for this case, I will now take, I will take 240,000 divided by 5 times 50. Times 50 for you to get the market value. So when you work out that carefully, your answer you get is 1,600,000. Stock here, we have been told it is 3 for the equity case. For the preference shares, I think we have not been given any information. Okay, so there is much information that is needed from this question. And because of that, because I don't know exactly the book value for the equity, therefore I will just remove, I will not use the market value, but I use the book value to calculate this. So what is the total book value here? So you add all that. So if you add, what do you get? If you add, what do you get there? 1,200,000. So this is my book value. So here I have to use the book value. So it will be this times, what is the book value for equity? Book value for equity is 360 times 360 plus cost of preference. Cost of preference are found to be 10% times the book value of the preference, that is 240, plus cost of retained earnings. Cost of retained earnings are found to be 14%. Then I'm multiplying by the book value of retained earnings, that is 300. Then I have also calculated plus the value of debt. The value of debt there are found to be 4.2% times the book value of the debt, which is 300,000. Once I get this one, I will divide everything by the total, which is 1,200. So work out that, work out this, work out this, work out this. Your answer you get there is 11%.
the answer you get there is 11%. 11%. Now, that is how you are supposed to answer that particular element. So therefore, class, I would like you to do example 8. Example 8, do example 8. Then do example 9. And do example 10. And do example 10. Then go to example 11. So those are the four questions. Kindly do the same questions and share with me via WhatsApp on 0735 346 777. And if you have any challenge on the 4 questions, kindly reach me and I'll be able to analyze. So therefore, that one marks the end of our today's lesson. So the end of the lesson, I said we are supposed to achieve 1, to explain the meaning of the word capital structure. Number 2, we are supposed to know how to factors affecting capital structure. Then we are also supposed to know how to explain the cost of capital and then the components of cost of capital and computation. So I'm very sure that I've now attained my 5 objectives. So for that reason, the remaining questions are yours. Do and share with me and I'll be able to guide you. Thank you so much and have a blessed evening.